Hi everyone. Today we're going to talk about the news that's on almost all the newspapers and channels everywhere is that the US inflation has hit a 39-year high. It's the highest since June 1982, and obviously this is expected to impact the market, and we're expecting an interest rate hike, and we're going to talk about that today. So just before we get into that, let me just give you a small disclaimer here that this series of what's moving the markets, it's a casual series. This is not investment advice. So guys, please do your due diligence before taking any investment decisions. Now, on the 12th of January 2022, the US Bureau of Labor Statistics reported the closely watched CPI index, which is the consumer price index, and it went up 7%, right? From 2020 December to 2021 December. And this is huge. This is the highest in 39 years. And everybody is a little worried. So, what does this mean for the equity market? We'll be talking about that today. But for those of us who don't know that much about inflation, we'll talk a little bit about inflation. Then we'll also talk about why it's important. Then we're going to get into what the government is expected to do, what we can expect to see next, and how that's going to impact the market, how it can be expected to impact the market, and what could be a possible strategy that me and you can do to safeguard our investments, right? So in terms of inflation, there's two broad categories. There's cost push inflation and there's demand pull. Cost push inflation is when the raw material and the input prices go up. So whatever is the input in the production process, those prices are going up, and this is what we're seeing right now, right? So for example, copper prices, oil prices, I mean, all of these are going up right now. So if you can open up whatever charting software you use and just look at the price of copper or oil, all these prices have been going up. And there is a very high level of employment as well. So naturally, labor is also becoming expensive. So there is a very high likelihood that what we're seeing right now is cost push inflation. Demand pull inflation, on the other hand, is when the economy is doing really well and everybody is kind of fighting for the same goods and services and kind of pushing the prices up as well. So it could be possible that we're seeing demand pull inflation as well. But looking at the commodity prices, and what we're talking about these days is the super cycle of commodities. So with a super cycle of commodities, it's highly likely that what we're seeing is cost push inflation. But let me also explain to you how that is different, right? In terms of why cost push inflation is really bad. So first, you need to understand what is the long-run macroeconomic equilibrium. So this is where the suppliers, the aggregate supply and the aggregate demand kind of agree. And this is where the long-run aggregate supply lies at the full employment. So this is our full employment. And at this point, this is a price level at which the suppliers and the supply and the demand agrees at this price level for this level of output. So this on x-axis, what you see is the output level. Now in the short run, sometimes what happens is, like for example, we saw in March 2020 when there was the lockdown that things were not looking too good, right? So the aggregate demand kind of came down, and when that happens, so before it came down, this is the price level that we were at, and this is the output level that we were at. And then when the aggregate demand comes down, so people are willing to pay less and buy less, right? So the economy kind of goes into a recessionary gap. Now, this is not that bad a situation because the government has the tools to fix this. So what we can do, the government, what it can do is it can reduce interest rate and it can increase money supply. So it can just pump money into the system and make money cheap, and everybody kind of comes back with their demand, and the aggregate demand goes back up, and the economy comes back to the same price and the same output level. On the other hand, what happens is an inflationary gap. In this situation, the aggregate demand goes up, right? And this usually happens when the economy is overheating. So people were buying at this price, at this output, and now people are very happy. So they're even willing to buy at higher prices, at higher output. Again, not a very bad situation, easily controllable by the government. They can increase the interest rate. They can reduce the money supply, which is the opposite of what they would do in a recessionary gap. And they can very easily control this. situation as well. Now, the troubling part is where you have stagflation. Now, in this situation, the prices also go up, but it's not because the aggregate demand is going up. It is because the supply is moving towards the left. Now, for the same amount of output, this is the price the suppliers were charging before, and now because the supply has moved leftwards, the prices that the suppliers are asking is higher because the input costs have gone up. So over here we're looking at cost push inflation, right? And because the suppliers, they are having higher raw material cost, higher input cost, they're asking for higher prices. And this is very hard for the government to control, because even if they kind of like do the same strategy that they were doing over here by increasing interest rate and reducing money supply, and they kind of like try to pull back the aggregate demand. So if they try to reduce the aggregate demand over here, and let me show that to you. So let's say the government tries to pull it back, right? So what happens? With the new aggregate supply that we have and the new aggregate demand that we have. So let's see where these two intersect. So this is the new aggregate demand and this is the new aggregate supply, and they kind of intersect over here. So the price level is low and the output is, so they are able to bring the price level back down to where it was. So that's fine. The government is able to control the price level, but look at what happens to the economy. I mean, this is where our output was, and from here, the output has come down to here, and that is a huge drop, right? So it's very, very bad for the economy, and stagflation is a difficult position to be in. So that's why it's very important to watch inflation, because this sustained overall increasing of prices in the economy, which we measure through the percentage change in a price index, allows us to infer the state of the economy. And if you're seeing high inflation and unemployment is low, that means the economy is overheating. And if that is happening, then it could trigger a change in the monetary policy, which could impact asset prices. So for example, if interest rates go up, then asset prices will very likely come down. And that is something we have to be very, very careful of. Now, again, inflation is pro-cyclical. What that means is when the business cycle is going up, inflation is also going up, right? And then kind of peaks at the top, and then we just roll down, and then it goes into the downturn, right? The economy. So we obviously don't want to be holding on to assets that are going to go down when this happens, and we want to sell at the peak. When the economy is in a kind of a recessionary gap, so when there is a recession, then the government can obviously have your expansionary monetary policy, right, where they will take the interest rates down and they will take the money supply up. But that's not what we're seeing right now. What we're seeing is high rates of inflation. So right now inflation is high. It is higher than it has been in 40 years almost, right? So what is highly likely is that we're going to see contractionary monetary policy. And what happens in contractionary monetary policy is that the interest rates go up. They go up beyond the neutral rate of interest. So the neutral rate of interest is a rate that neither spurs nor slows the economy. And now if the government wants to kind of slow down this inflation, then they have to take the interest rate beyond this neutral rate. So interest rate will go up greater than the neutral rate. And that is very, very bad for asset prices. And why it is bad for the asset prices, let me tell you. So see, this is what a firm value is coming from, where the firm generates some cash flow, so what we call free cash flow to the firm, right? And that is going to be impacted in two ways. Now, number one, part of this cash flow that the firm is generating goes to pay off bank debt, right? Whatever borrowing the firm has, and the remaining amount is available for the owners of the stock. Now, when the cost of debt goes up, when the interest rate goes up, that means the loan amount or the interest they have to pay on their loans, it goes up. Means the remaining amount which is available for the equity holders goes down, right? Because less money will be available for the dividend payments, or less money will be available for reinvesting in the business for growth. So naturally, the value of the stocks comes down. The other problem is that this future cash flow, which is going to come in the future, whatever future income the companies are expected to make, the present value of that cash flow. So this present value of this future cash flow is kind of calculated using a certain required rate, right? So what we do is we do 1 plus the required rate to the power of n, depending on which year it's coming in. So n is the number of years. And we discount it back to today to calculate the present value. And if this denominator will go up, because this required rate is actually it's derived from the interest rate. So interest rate goes up, required rate goes up. Required rate goes up, that means the present value comes down. Present value comes down. So it's a double whammy for the stock market, because number one, equity holders get less money as it is, because more money is used for interest payments, and whatever money there's left for them is also valued at a higher discount rate, and the present value of that comes down. So double whammy for the market. However, it's not all doom and gloom. There is a possibility for us to safeguard our investments, and again, not investment advice. I can just kind of share my perspective, and then you obviously have to do your own research. But not all companies are cut from the same cloth, right? So the impact of inflation, it differs from company to company, and even within a single company. So one business division might be able to do well and the other might not be, right? So some companies actually have a better ability to pass on the higher input cost by raising their prices. And that is what we need to analyze in a company if we are buying their shares, that do they have the ability to pass on prices? For example, if I like to drink Coke, and even if it becomes a little bit expensive, I might still not stop drinking Coke, right? Or if I like to use Apple products, then even if the price goes up a little bit, I might still continue to use Apple products. So what we need to evaluate is that the company that we are interested in investing in, does it have the ability to pass on this price or not? And if it does, then it's more likely that they will be able to have sustainable, stable profits and cash flow relative to their competitors. So look for companies that have good brands, good technology, proprietary technology. And the second thing we need to look for is that if they have been able to lock in low rates of borrowing. So again, I'm giving you an example. This is just a random example, not investment advice, that Amazon locked in 3-year debt at an interest rate of 0.4% per annum, right? So they got 10 billion through this US corporate bond issue, which was the cheapest ever. So look for companies that have been able to lock in their debt at low rates. So lock in their debt at low rates. And secondly, look for companies that have the ability to pass on price increases. So happy investing, guys, and hopefully I shall see you in the next video, inshallah. Thank you very much.